Hello everyone, this is Darren. Welcome to my channel. In this video, we're going to talk about ETFs on the Canadian market that are worth holding for the long term. I live in Toronto and work as a salaried employee, earning Canadian dollars rather than US dollars. So my portfolio primarily consists of ETFs traded on the Canadian market. Before diving into the recommendations, let me quickly explain something for beginners. When we talk about stocks or ETFs traded in the Canadian market, we generally mean those listed on the Toronto Stock Exchange, TSX. These stocks can be Canadian or US companies. There's a misconception I've heard from people who think they need to exchange CAD for USD to invest in American companies, because US companies perform better. That's not true. You can use Canadian dollars to invest in US companies via the Canadian market and still achieve great returns. It's incredibly convenient for Canadian investors to invest in US stock market, mostly through ETFs that hold American companies. In this video, I'll share some highly recommended ETFs traded in the Canadian market, many of which I personally hold in large amounts. If this is your first time on my channel, I focus on recommending high-quality stocks and ETFs, especially covered call ETFs. Whether you invest in the US or Canadian stock markets, my content is designed to help you. The data used in this video comes from Seeking Alpha, and their Black Friday sale is on now. Until December 11th, you can subscribe to Seeking Alpha and Alpha Picks using the links in my description to enjoy $90 and $140 in cash discounts. It's a fantastic deal, so make sure to check it out. If you enjoy content like this, please take a moment to like this video and subscribe to my channel. It helps the YouTube algorithm recommend my videos to more investors and motivates me to keep creating content. Now, let's jump into today's topic. First, let me recommend two growth ETFs that track US major indexes, VFV from Vanguard, which tracks the S&P 500 index, and HXQ from Global X, which tracks the Nasdaq 100 index. There are many similar ETFs, such as ZSP and XUS, which also track the S&P 500, and ZNQ and XQQ, which track the Nasdaq 100. Some of you might wonder which one to choose. The differences between them mainly lie in aspects such as net assets, tracking error, and ETF fees. In terms of actual performance, the differences are negligible. My personal recommendations are VFV and HXQ. Over the past year, their total returns were 38% and 40%, respectively, with HXQ slightly outperforming. Over a longer timeline, in the past 5 years, VFV delivered a total return of 108%, while HXQ returned 181%. Since the Nasdaq 100 has a higher weighting of tech stocks, HXQ offers greater long-term growth potential. However, it also experiences higher short-term volatility, especially during bear markets. For example, in the 2022 bear market, VFV dropped 14% over the year, whereas HXQ doubled that decline with a 28% drop. Therefore, I suggest holding both of these index ETFs, while maintaining a 2-to-1 allocation in favor of the S&P 500. This approach ensures broader diversification across industries and companies, spreading out risk more effectively. Later in this session, I'll also introduce some defensive ETFs that are better suited to weather bear markets, like the one we saw in 2022. For Canadian investors, since most of our daily exposure is to Canadian companies, many people still prefer to invest in them. In this case, I recommend VCN, VCE, or XIU, all of which track the Canadian market. Over the past year, their total returns have been around 30%, slightly lagging behind the S&P 500. The advantage of investing in the Canadian market is that it helps diversify your investment portfolio. For example, in the 2022 bear market, the S&P 500 in the US fell by 14%, while these broad Canadian market ETFs only declined by about 6%. In the US stock market, whether it's the S&P 500 or the Nasdaq 100, technology stocks have a significant weighting, followed by healthcare and consumer sectors. In Canada, the largest weightings are in financials, followed by energy and industrials. Holding both US and Canadian stocks creates a better portfolio composition in terms of sector diversification. This allows you to own stocks from all the major industries across North America and benefit from their growth potential. In addition to growth ETFs, we can also invest in the North American markets through covered call ETFs. If you're not familiar with covered call ETFs, I'll explain them in detail in a future video. Simply put, a covered call ETF sells call options on a portion of its portfolio to generate premium income. This essentially trades off some growth potential for high cash flow, often in the range of 10% to 15%. Since distributions from covered call ETFs are usually stable and not subject to market fluctuations, investing in them allows you to largely ignore market movements. These ETFs are ideal for retirees relying on dividend income or for conservative investors with lower risk tolerance. Covered call ETFs are also great for beginner investors, as they require little effort, just set up recurring investments to earn steady returns. For covered call ETFs that track S&P 500, I recommend HYLD from Hamilton ETFs and USCL from Global X. For those tracking the NASDAQ 100, I recommend QMAX from Hamilton and QQCL from Global X. For the Canadian market, I suggest HDIV. While Global X also offers CNCL, which tracks Canadian indices, its overall performance is relatively weaker, with lower net assets and liquidity, making it less desirable to hold. If you're interested, I'll cover these covered call ETFs in detail in future videos. After covering broad market ETFs, let's move on to single stock covered call ETFs from Purpose ETFs. It includes YTSL, which only holds Tesla, YNVD, which only holds Nvidia, and BTCY, which holds Bitcoin. These ETFs use a 50% coverage ratio for their option strategy, selling out-of-the-money call options on half of the portfolio, while keeping the other half open for growth. Additionally, they employ 25% leverage to enhance both yield and growth potential. These three ETFs have gained significant popularity recently. Over the past 6 months, YTSL surged 96%, YNVD climbed 10%, and BTCY rose 30%. These returns include both share price appreciation and dividend income. YTSL currently pays a monthly dividend of 30 cents per share, with a dividend yield of 14%. YNVD pays 75 cents, with a dividend yield of 20%. BTCY, benefiting from Bitcoin's recent surge, has seen its monthly dividend increase by 60% from $0.0525 to $0.085, pushing its dividend yield to 12%. Speaking of Bitcoin, let's also talk about BTCC, another Purpose ETF that directly holds Bitcoin. It was the first Bitcoin ETF in North America and globally. BTCC launched in February 2021, with total assets now reaching $3.5 billion. Over the past year, BTCC delivered an impressive 131% return, while BTCY achieved 95%. Given Bitcoin's recent rally, both ETFs have performed exceptionally well. However, during a bear market or periods of sideways trading, BTCY's stable monthly income could lead to higher overall returns compared to BTCC. For long-term Bitcoin bulls, I recommend BTCC for consistent dollar-cost averaging. More conservative investors might prefer BTCY, which provides regular dividend income alongside Bitcoin exposure. With Trump's election victory increasing Bitcoin's perceived certainty, opportunities have also emerged in stocks like MSTR and MARA, which benefit directly from Bitcoin's success. While I don't recommend these highly volatile stocks, I do believe everyone should find a way, one they're comfortable with, to invest in Bitcoin and not miss out on its growth potential. Adding these 3 single-stock covered call ETFs to your portfolio can significantly enhance overall returns and boost cash flow. However, keep in mind that they will also increase the volatility of your portfolio. To balance this, I'll next recommend some defensive ETFs to stabilize your investments. The first defensive ETF I'd like to introduce is FCUV, a growth-oriented ETF from Fidelity that tracks U.S. value companies. Launched in June 2020, it currently has a net asset value of $860 million. Their fund managers select temporarily undervalued stocks in the U.S. market, with strong potential for long-term returns. Over the past year, FCUV achieved a total return of 41%, outperforming both the S&P 500 and Nasdaq indices during the same period. However, its value isn't just about beating the broader market. Looking at its performance in 2022, when the S&P 500 and Nasdaq experienced significant declines, FCUV actually posted a slight gain of 0.44% for the year. Over a longer horizon, FCUV has delivered a total return of 72% over the past 3 years, and since its inception in 2020, it has achieved an impressive total return of 154%, surpassing both the S&P 500 and Nasdaq indices during the same timeframe. Including FCUV in your portfolio can help you achieve growth returns higher than the broader market, while also making your portfolio more stable and diversified. The second ETF I recommend is an ETF that invests in gold. Gold is an effective safe haven asset. During times of market uncertainty, geopolitical risks, or economic downturns, investors often turn to gold to protect the value of their assets. In Canada, there are several ways to invest in gold, and I recommend Kilo from Purpose ETF, because it offers the lowest cost, with an MER of only 0.2%. Over the past year, Kilo has delivered a total return of 34%, and over the past 3 years, it has returned 46%, outperforming the S&P 500. During 2022, when U.S. equities declined, Kilo posted only a slight annual loss of 0.25%. Another worthy option is AMAX from Hamilton ETF, which is a covered call ETF holding North American gold mining companies. It was launched in February of this year and has already achieved a total return of 35%, even surpassing the performance of gold itself. AMAX also offers a dividend yield of 10%. If you're looking to invest in gold as a hedge while earning a solid cash flow, AMAX is also an excellent choice. The final stock recommendation for today is my personal favorite ETF available in Canada, from Brompton ETF, the all-in-one preferred share ETF with the ticker symbol SPLT. Launched in June 2023, SPLT currently has a net asset value of approximately $150 million. Over the past year, its total return was 11.7%, which is far below the S&P 500's 39% over the same period. So, why do I so strongly recommend this ETF despite its lower returns? Take a look at this performance chart. Compared to the S&P 500, SPLT's growth curve is remarkably smooth, almost a stable, straight upward line. It also pays monthly dividends, which started at 5 cents per share and increased to 6 cents per share, maintaining a dividend yield of around 6%. Alongside its stable dividend payouts, its share price has also grown steadily by about 6% annually, without any significant downturns. We all know that over the past year, the U.S. stock market experienced several notable corrections. For instance, between mid-July and early August, the S&P 500 dropped nearly 10%. SPLT, however, remained unaffected, its share price and dividends were entirely stable. I use SPLT as a savings account, maintaining a 10% to 20% allocation in my portfolio. During bull markets, I gradually increase my position in SPLT to prepare for potential pullbacks. When pullbacks occur, I sell some SPLT holdings and reinvest the funds into other opportunities, so I can constantly buy stocks at a lower price. Some might ask, if SPLT is essentially a cash position, why not use a more stable cash ETF, like cash from Purpose ETF? Keep in mind that the dividend yield of cash ETFs is closely tied to bank interest rates. In the current environment of declining interest rates, cash's dividend yield is under 4%, and its principal value does not grow at all. Over the past year, cash's total return was less than 4%, far below SPLT's performance. Compared to GICs or high-interest savings accounts, SPLT also outperforms in terms of overall returns, dividend yield, and flexibility. The only drawback is that SPLT, as an ETF, carries the potential for price declines. However, based on its performance since its launch, SPLT has demonstrated a level of stability that I find highly reliable. In my 10+ years of investing in US stocks, I have never come across an ETF that is as stable and capable of delivering consistent growth as SPLT. Today, we've introduced a number of ETFs, so let me wrap things up with a summary and some recommended portfolios. I've prepared 3 different portfolios, tailored to regular investors, aggressive investors, and conservative investors. Of course, these are just my subjective suggestions, and you can replace any ETF based on your own risk tolerance and investment preferences. First, for regular investors, the core holdings would focus on broad market indices, with 20% VFV, 10% HXQ, and 10% VCE. Then for growth potential, we rely on single stock covered call ETFs, 5% for each of YTSL, YNVD, and BTCY. For defensive ETFs, we allocate 15% for FCUV, Kilo, and SPLT respectively. This portfolio has an average annual return of 41% over the past year, including an annual dividend yield of 6.2%. The second portfolio is designed for investors who are willing to take on higher risks for potentially higher returns. We would allocate 20% each for VFV and HXQ. Since Canadian market has historically underperformed the S&P 500, there is really no need to include it in this portfolio. For growth potential, we allocate 10% each for YTSL, YNVD, and BTCY. Then for defense, we allocate 10% each for FCUV, Kilo, and SPLT. With this setup, the total return over the past year could reach 51%, and the higher weighting in single stock covered call ETFs boosts the portfolio's dividend yield to 10%. The third portfolio is ideal for those who are retired or rely on dividend income for daily expenses. Instead of regular index ETFs, we use covered call ETFs for core holdings, 15% each for HYLD, QQCL, and HDIV. We still keep 5% each for YTSL, YNVD, and BTCY, for their nice high yield and high growth potential. Then for defense, we allocate 10% each for FCUV and Kilo, then 20% on SPLT. This portfolio achieved a total return of 38% over the past year, still outperforming the S&P 500. Additionally, it generates a 13% dividend yield. That means if you have $10,000 invested in this portfolio, you'd have $110 steady monthly income. If you have $500,000, you'd earn $5,500 per month, which is enough to declare early retirement or financial freedom in most cases, assuming you have no large debts. Another good thing about this portfolio is, even if you spend the entire $5,500 every month, your $500,000 principal continues to grow and won't be eroded by the dividends. This is one of the reasons I personally love covered call ETFs. You can see your monthly dividend income steadily growing, giving you a clear picture of when you might achieve financial freedom. That's all for today's video. I'll continue sharing and discussing topics related to covered call ETFs in future videos. I'll also keep releasing similar videos with individual stock and ETF recommendations, so feel free to follow along if you're interested. The data and analysis used in my videos come from Seeking Alpha. If you're interested in Seeking Alpha and their stock recommendation platform, Alpha Picks, you can use the referral link below to get an incredible Black Friday discount. If you enjoy my stock analyses, portfolio recommendations, and content about covered call ETFs, please give this video a thumbs up and subscribe. Your support is my greatest motivation to keep creating new videos. Thank you for watching, and see you in the next one.